Well, billionaire investor Wilbur Ross is joining us now. He is known for investing in distressed assets, restructuring failed companies. His largest holdings are in oil and coal. Wilbur, great to have you back on the program with us.
Good to talk with you, Betty.
Well, Wilbur, while you've been in China over these last few days, as you know, the stock markets here have been tanking on all these concerns about the economy. What do you think is going on?
Well, I think the economy will continue to bumble along, but without any powerful direction. What we just saw this last series of data released were some negative numbers. I think there'll be weeks that are positive, weeks that are negative. So our conclusion is it'll have a slight upward bias, maybe a 2.5% to 3% gross domestic product gain. Mm-hmm. And that's about it. And that's not enough to bring down unemployment.
And we're not headed into a recession, is what I'm hearing from you, right?
I don't see a double dip coming. I just see a fairly lackluster environment.
And that means what for the stock markets then?
Well, I think the market has already kind of adjusted to that sort of an outlook. So I believe from here on in, it's going to be more a market of stocks than it is a stock market. I think individual selections are what people are probably going to have to focus on.
And Wilbur, you have obviously a very keen eye on what's value out there and what's cheap. And we've been talking so much, Wilbur, about how bank stocks are so cheap right now, some of them trading below their book value. Why aren't investors buying up these bank stocks?
Well, I think there's a whole variety of things. At the very big bank level, there's concern about the reallocation of credit card fees between the big banks and the big retailers. There's legislation scheduled to go into effect very shortly that will divert quite a lot of money, many, many billions of dollars, from the big credit card banks to the Walmarts and the other retailers.
You're talking about the debit card fees, right?
Yes, exactly.
Okay.
So that's one direction. There's continuing discussion from regulators. How much capital should banks really have to hold, that kind of thing. Mm-hmm. So that creates some uncertainty. And then at the smaller banks, there's continuing, I think, correct uncertainty about the quality of the portfolios. It's only meaningful to say it's trading below book if you're really convinced the book value is real. But the regional banks have 37% of all their assets in commercial mortgages, and that's a lot. That's way more than their total capital, maybe 1.5 times, 2 times their total capital. So if there's a real continued attrition in commercial real estate, it raises a serious question: what is their book value?
Right, and the reason why I said is because that is exactly what some have been saying to us, which is that it's hard to value these banks if you don't even trust the values of the assets that they hold, and that's what you're saying, Wilbur, right? I mean, that is.
Well, yeah, it depends on the bank.
Right.
The FDIC continues to have some 888 banks on their watch list, and the aggregate assets of those banks, something on the order of $400 billion. So it's a very big number, even though the individual banks are kind of medium-sized. So then are you or are you not tempted to load up on some more banks? Well, we've already, as you know, did quite a few banks with FDIC assistance. We're very happy with those. And those are different because those are cleaned up. They were seized by FDIC. Proper due diligence was done on the loan portfolio. Loss sharing agreement was entered into with FDIC. So when they come back out, they are clean, and you know what's in there. And so I think that's why ones like one of ours is Bank United is trading at a substantial premium over book value, because everybody knows its book value is quite real and it has quite good earnings locked in. Wilbur, I remember before, last time when we talked, you were looking into the muni bond markets. Have you bought anything yet? Well, yeah, I think the muni market offers pretty good value. I think all these people saying that there's suddenly going to be a big wave of defaults. I just don't see it. In fact, in today's paper, you saw Jefferson County, Alabama, which has been a real problem child due to the sewer authority and some bad hedges that they put on. They're talking about laying off 1/3 of their workforce in the entire county. That's the kind of discussion you never would have heard out of a local government in the old days. But I think you're going to see more and more budget clampdowns at the local level and at the state level.
Right.
And while I think that's going to create some unemployment problems and partially offset the little growth in private sector jobs, that's a much better solution than a default. And I think the politicians are starting to get the idea that that's the direction they should go.
But Wilbur, then what part of the muni bond markets are you buying then? What debt looks attractive?
Well, we haven't done any yet, as all we've been doing is kind of refining our thinking, because our real concern is not munis on a creditworthiness. Our real concern is that with the end of QE2 and the still unresolved question about federal deficit, we think there's a real question whether basic money rates may well go up. And if they do, obviously that would be a negative for munis. So our feeling about munis is we are comfortable with the creditworthiness. We're biding our time a little bit to get some more clarity on the direction of rates.
Okay, interesting. All right. Wilbur, thank you so much. Really appreciate you taking the time. I know
Thank you, Betty. Good to talk with you.
Nice to talk with you as well. A busy man there. That was billionaire investor Wilbur Ross.